Most people don't lose their money in the stock market because they picked the wrong stock. They lose it because the entire system is quietly tilted against them. High fees, constant trading, slick marketing, and bad incentives drain their returns year after year, while Wall Street gets paid no matter what happens to their portfolio. John C. Jack Bogle, the founder of Vanguard and the father of index investing, spent his entire life exposing this game and showing ordinary people how to win it. He wasn't a flashy hedge fund star. He didn't promise to beat the market. Instead, he built an entirely different way to invest, one designed to keep more of the market's return in your pocket, not in Wall Street's. In this video, we're going to walk through 7 traps that quietly steal your money and how Jack Bogle's philosophy helps you escape every single one. If you're investing already, you'll probably recognize yourself in at least a few of these. If you're new, this might save you years of frustration and hundreds of thousands of dollars over your lifetime. Let's start with a simple idea Jack Bogle repeated over and over. In the long run, the stock market gives investors a pretty good return. The problem is not the market. The problem is what we let Wall Street take out of that return before it ever reaches us. The game is not about finding magic stocks. The game is about minimizing how much of your wealth leaks out through fees, bad behavior, and unnecessary complexity. Trap number 1, the only 1% fee that quietly eats your future. On paper, a 1% annual fee sounds harmless. If your fund returns around 10% and you pay 1% in fees, you still keep 9%. 9% still sounds great, but that's how the trap works. It hides in the word just. Just 1%, just a small management fee, just a tiny advisory fee. When you stretch that 1% across 20 or 30 years of compounding, it can easily cost you hundreds of thousands of dollars. Imagine you invest $10,000 every year for 30 years. With a simple, low-cost index fund that charges almost nothing, your money compounds very close to the market's long-term average. With a higher fee fund, that same return is dragged down every single year. The difference doesn't show up immediately. It shows up at the end when it's too late to fix. Jack Bogle's message here was brutally simple. Costs matter. Every dollar you don't pay in fees is a dollar that can stay invested and keep compounding for you and your family instead of for your fund manager. The first trap is believing small fees don't matter. They do. They are often the difference between a comfortable retirement and constantly worrying if your money will last. Trap number 2, the illusion that more trading means more intelligence. Wall Street gives you apps, notifications, constant news, green and red candles, pre-market, after-hours, options, leverage, you name it. It feels like being active equals being smart. Doing nothing feels lazy, even irresponsible. But the data over and over again says the opposite. Most active traders and most actively managed funds underperform simple, low-cost index funds once you include costs and taxes over 10 or 20 years. The more you try to outsmart the market, the more you usually end up outsmarting yourself. Jack Bogle had a simple rule of thumb. Don't just do something, stand there. Own a broad slice of the market at low cost, then let time and compounding do the hard work. Every time you buy and sell, you pay spreads, maybe commissions, and often trigger taxes on your gains. You turn what could have been long-term, tax-efficient compounding into a series of small, expensive decisions. Wall Street loves this because trading volume is where a lot of its revenue comes from. Jack Bogle's approach is the opposite. Buy a low-cost index fund, hold it for decades, and let everyone else exhaust themselves trading against each other. Trap number 3, complexity that hides risk and cost. The financial industry loves complex products, structured notes, leveraged ETFs, exotic strategies, products with 30-page brochures and 2-page fee tables. The more complex the product, the easier it is to hide what you're really paying and what risk you're really taking. As an ordinary investor, it's very hard to know whether a complex strategy is helping you or quietly draining your account. Jack Bogle believed that simplicity is not a weakness, it's a strength. A global stock index fund and a simple bond index fund can give you all the diversification most people will ever need without layers of hidden risk. You don't need a portfolio of 20 complicated funds with clever names. You need a clear, simple plan you understand well enough to stick with when markets get rough. Complexity makes it easier for Wall Street to charge more and for you to blame bad outcomes on the market instead of on hidden costs. Simplicity forces everyone to be honest about what's really going on. Trap number 4, over-diversification that looks safe but performs like a mess. You've probably heard, don't put all your eggs in one basket. That's good advice, up to a point. The problem is that many investors end up doing the opposite of what Jack Bogle recommended. Instead of owning one or two broad index funds that cover the whole market, they collect a random list of funds, sector bets, and trendy themes. They own a little of everything, but don't really know what they own. Bogle's philosophy is that true diversification is owning the entire haystack, not one shiny needle after another. A single total market index fund can already spread your money across thousands of companies. Adding more and more overlapping funds rarely makes you safer. It just makes your portfolio harder to understand and often more expensive. When you own a pile of funds with different fees and strategies, it becomes almost impossible to know where your risk really is. Real diversification is simple. One or a few broad funds that together cover the major asset classes you need with clear percentages and a clear rebalancing plan. Trap number 5, chasing last year's winners. Every year, some fund, sector, or stock explodes in performance. Financial media and marketing jump on it. If you had invested $1,000 in this fund 5 years ago, you'd have X today. It's extremely tempting to look at these charts and think, I should be in that. This is how many investors end up buying high and selling low, constantly rotating into what just had a great run only to suffer through the inevitable decline. Jack Bogle's response to this was simple. Past performance is a terrible predictor of future outperformance, especially after fees. What matters is owning the entire market at low cost and staying put, not trying to jump from star to star. The more you chase recent winners, the more you pay extra in fees and taxes, and the more likely you are to miss the quiet but powerful effect of long-term compounding in a simple index fund. Instead of asking what won last year, Bogle would have you ask, what simple portfolio can I hold for the next 20 or 30 years without flinching? Trap number 6, letting your emotions drive the car. Fear and greed are part of being human. When markets crash, headlines scream, social media panics, and your portfolio is bleeding red, every instinct tells you to sell and wait for things to calm down. When markets are booming and everyone around you seems to be getting rich quickly, every instinct tells you to jump in, even if it means stretching beyond your risk tolerance. This is how many investors do exactly the opposite of what they know they should do. They buy high when it feels safe and sell low when it feels terrifying. Jack Bogle's answer was not to pretend emotions don't exist, but to build a strategy that doesn't depend on perfect emotional control. A simple rules-based plan, like investing a fixed amount into a broad index fund every month, regardless of headlines, helps you act consistently even when your feelings are screaming to do something else. Instead of reacting to every market move, you decide in advance how much risk you're willing to take, what mix of stocks and bonds makes sense for your age and situation, and you stick to it. When markets crash, you remind yourself that lower prices are a long-term opportunity, not just a threat. When markets soar, you remind yourself that trees don't grow to the sky and that your plan matters more than bragging rights. Trap number 7, believing you need to beat everyone else to win. Wall Street sells the dream of alpha, beating the market, finding hidden gems, doing better than your neighbors. The truth Jack Bogle pointed out is brutal. Before costs, investors as a group must earn the market's return by definition. After costs, the average investor must underperform the market's return. The more you pay in fees and the more you trade, the more likely you are to be on the losing side of that equation. Bogle's philosophy flips the goal. You don't need to beat everyone else to win. You just need to capture as much of the market's return as possible at the lowest possible cost for the longest possible time. If the market over decades delivers something like 10% before costs, and you quietly collect close to that, while most people give away chunks of it in fees, bad timing, and speculation, you win by simply not losing what others are throwing away. That is the quiet power of index funds and long-term discipline. So what does escaping these 7 traps look like in practice for an ordinary person? It doesn't look like day trading. It doesn't look like watching charts at 3 in the morning. It doesn't look like hunting for the next hot stock on social media. It looks almost boring from the outside. You pick one or a few broad, low-cost index funds that give you exposure to the global stock market and, if appropriate for your age and risk level, a simple bond index. You decide on a reasonable split between stocks and bonds. You invest a fixed amount regularly, every month, every paycheck. You avoid high-fee products, complex strategies you don't fully understand, and constant trading. You accept that there will be crashes, bear markets, recessions, and scary headlines. And you choose to stay the course anyway. Jack Bogle never promised that this path would make you rich overnight. What he showed is that over 10, 20, 30 years, this simple, low-cost, disciplined approach has given millions of ordinary investors better results than most professionals achieve after fees. You don't have to outsmart Wall Street at its own game. You can refuse to play that game in the first place and instead play a different one. Keep costs low, keep behavior rational, keep time on your side. The system may be tilted, but you're not powerless. Every choice you make about fees, trading, complexity, and emotion either feeds Wall Street or feeds your own future. Jack Bogle's challenge to you is straightforward. Stop giving away pieces of your return for nothing. Own the market through index funds. Hold it for the long term. Let compounding work quietly in the background while you get on with your life. That's how the ordinary investor stops being the victim of these traps and starts becoming the owner of their financial future.